All right. So looks like some folks are still joining. So all right, wonderful, wonderful. Well, look, we got about 24 people. So thank you, everybody. Thanks for joining. And I think this is going to be exciting. Hopefully, you guys are going to learn a whole bunch of stuff and help you with your taxes and your strategies and so on. But uh, we'll do networking after Brandon presents. We'll have plenty of time for that. And what I'll do is, we probably have a packed hour. So thank you, Brandon. We've never met in person, but we've been Facebook friends for a long time, and really enjoy everything that you've done for the community, for the real estate community, and just wanted to welcome you to I think this is your first presentation to our group. So thank you for making the time. I know you're super busy. So with that, the digital floor is all yours. And then folks, if you have questions, you can chat the questions in the chat box. It'll come to Brandon or myself, and then we'll relay the questions over to the audience. And then also we will open it up later on for Q&A. But we got an hour, and I think we'll do great. So Brandon, it's all yours.
All right, sweet. Thank you very much, Bobby. I appreciate the invite to the group. I'm really excited to be here. And just for show of virtual hands, type 1 into the chat if you're a landlord, and type 2 if you're something else. Is anybody chatting? Okay, there we go. I've got pride. You can, yeah, okay, that works. So we've got some 1s, got some 2s. Looks like, okay, a lot of 1s. Real estate agents. Sweet. Okay, cool. So what we'll do then is I'll talk a little bit about how landlords benefit from investing in real estate tax-wise, and then we'll also throw some bones to the folks that are real estate agents and working in real estate full-time, but maybe not necessarily a landlord. So let's start. Now I know that I was supposed to come up with 10 things to to do tax-wise, and I have lots of things. We'll see how many we can make it through. So the very first big tax opportunity for landlords is to qualify as a real estate professional. So when you buy rental real estate, all rentals are by default passive. And you essentially, when you think about it, you have 2 types of income. You have passive income, and then you have non-passive income. So you've got 2 buckets that all income goes into: passive and non-passive. My passive income can be offset by passive losses, but my non-passive income cannot be offset by passive losses. So if I generate passive losses, I can only offset passive income or gain on sale from a passive activity. Now, my W-2 income, my business income, if I'm a real estate agent or a CPA, all of that, that's all non-passive income. I materially participated in the activity to generate the income. So it's all non-passive. The passive income would be like private investments in businesses. It'd be rental real estate, basically a business that I don't materially participate in. That's passive. So if I generate tax losses from my rental real estate, it's going to be a passive loss by default. And I cannot use that passive loss to offset my W-2 income or my business income in most cases, if my income's high enough. So what you do is you qualify as a real estate professional. And this is a way to recharacterize my passive losses from my rental real estate as non-passive losses. So if I invest in rental real estate and I run a cost seg study, which we'll talk about in a second, and I'm able to generate $100,000 of first year bonus depreciation, that's $100,000 tax loss. If I'm able to use that $100,000 tax loss against my W-2 or my business income, it can easily save me $30,000. But if I can't use that $100,000 because it's passive and I can't recharacterize it, then it becomes suspended the loss becomes suspended and it carries forward. So ideally, I don't suspend my passive losses. Ideally, I'm able to recharacterize my passive rental losses as a non-passive loss. And to do that, I have to qualify as a real estate professional. To qualify as a real estate professional, I need to spend 750 hours in a real property trade or business in which I materially participate. I also need to spend more time in my real property trades or businesses. I need to spend more time in those real property trades or businesses than I do anywhere else. So because I run a CPA firm full time, I spend, 2,080 hours a year. I wish I spend a lot more than that. I spend 2,080 hours a year running my CPA firm. I have to spend more time in real estate than I do running my CPA firm to meet that test. So I have to spend an additional 2,081 hours a year, which is put me up to like 4,000 hours plus a year, which is just not going to happen, right? So you got to spend more time in real estate than you do anywhere else. Real estate agents, you automatically hit that if you're doing real estate agent stuff full-time. Wholesalers, flippers, builders, developers, you're automatically going to hit that. Full-time landlords, you're automatically going to hit that. But the second test is 750 hours. So not only do I have to spend more time in real estate, I also have to hit some minimum threshold, and that is 750 hours. So if I hit 750 hours of personal services and a real property trader business in which I materially participate, and if I also spend more time in real estate than anywhere else, then I am a real estate professional. Now, being a real estate professional means absolutely nothing as it pertains to my rental real estate. I also have to materially participate in my rental real estate. So here's what this means. If I'm a real estate agent full-time, that's all I do for 2,000 hours a year. I meet both those real estate professional tests, right? 750 hours and more than half my time. I meet both of those tests being a real estate agent full-time. So I am a real estate professional for tax purposes. But if I do not also materially participate in my rental portfolio, then all of my rental losses are still passive. So I always have to come back to the rental portfolio and ask, am I materially participating? Because I could be a real estate professional and not materially participate in the rental portfolio, and the losses are still passive. And remember, the entire purpose of this is to recharacterize my rental losses as non-passive. So that's the entire point. So what I want to do is qualify as a real estate professional and materially participate in my rental portfolio. There's 7 tests to determine material participation. You only have to meet one of the 7. The 3 that we see most often met are spend 500 hours in your rental portfolio, spend 100 hours and more than anyone else in your rental portfolio, or your participation is significantly all or substantially all of the participation in the activity, meaning that you essentially self-manage. So if I self-manage my property, there's nobody else really participating, I'm going to complete substantially all the participation, even though I'm only spending a couple hours doing it. Okay. So substantially all is the easiest test to meet. It's the lowest threshold test to meet. So if I'm a real estate agent full-time, I might want to self-manage my rental properties, because then I'll be a real estate agent. I'll hit real estate professional status, being a real estate agent. And then I'll also be able to show that I materially participated in my rentals because I'm the only one doing anything related to the rentals. That's substantially all the participation. So that's one of the 7 tests. The next easiest test to hit is that 100-hour test and more than anyone else. So if I have a property manager on the property, I have to spend 100 hours and more than the property manager. So if the property manager spends 105 hours, I have to spend 106 hours, 100 hours and more than the property manager. That's a very challenging thing to do because property managers don't track their time. So how are you going to be able to substantiate that you spent more than the property manager? Tough to do. If Bobby and I are partners, I in our rental partnership, I want to spend more time than Bobby, right? But he also wants to spend more time than me. So I spend 105 hours, then Bobby goes, no, I'm smarter. I'm smart enough to know that I've got to spend 100 hours more than you. So I'm going to spend 106 hours. And I, being the CPA, I'm like, well, I'm going to spend 107 hours. And we just stair step all the way up until we both hit the 500-hour test. So the 500-hour test is the hardest test to hit because it requires the most hours, but it is the safe harbor test. If you hit 500 hours, you're good. So I have to spend 750 hours in a real property trader business in which I materially participate and more than half my time. And then I also have to show that I materially participated in my rentals. Now, if all I'm doing is landlording, if that's my only real property trader business, then I've just got to hit 750 hours in my rental portfolio. I'm going to hit the material participation along the way, right? But it's when I'm doing other things other than landlording that I have to really watch out for that whole, hey, you can be a real estate professional, but your rental losses are still passive. So if I'm a landlord, that's all I've got going on. That's my only real property trader business. I could spend 750 hours managing my 4 rentals, and I'm also going to hit the 500-hour test along the way. But if I'm a real estate agent and I'm a real estate professional because I spend 900 hours being a real estate agent and it's all I do, then that's great. I'm a real estate professional, but I haven't materially participated in my rentals. So I also have to go and materially participate in my rentals. So that's the first big one. If I can qualify as a real estate professional, my losses from my rental real estate are non-passive. And non-passive losses can be accelerated through cost segregation. So this is my second one here. So cost segregation. Cost segregation is the practice of taking value out of your 27.5-year depreciation bucket and allocating it to 5, 7, and 15-year buckets. So when I go buy a rental property, I spend $100,000 on a single family home and $10,000 is allocated to land. So I'm left with $90,000 of building basis. I depreciate that over 27.5 years. Why 27.5 years? Because that's what the IRS says to do, or that and the Internal Revenue Code says to do. So 27.5 years, that's how long I depreciate that $90,000. But a cost segregation study is basically the practice of saying, well, I spent $100,000. I allocated $10,000 to land, so $90,000 is allocated to building. But it's not just that I can't just go and say $90,000 building, right? I have to spend $10,000 on windows and floors, $5,000 on the roof, $5,000 on appliances, $5,000 on cabinetry. Like there's a lot of things that go into the building to make up $90,000. And so a cost segregation study is the practice of identifying all of those separate things, the components of the property. They identify all the separate components ranging from electrical to HVAC to plumbing to flooring to windows to doors to roofs. And they basically try to say, hey, of the 90,000, 5,000 is allocated to this component, 10,000 is allocated to this component. But all those components have shorter lives. So they're not going to be depreciated over 27.5 years. Carpet's not going to last 27.5 years. So what we do is we have 3 new buckets that we can allocate value to. It's a 5-year bucket, a 7-year bucket, and a 15-year bucket. 5 and 7-year buckets are for personal property items like appliances, carpeting, cabinetry, things like that. The 15-year bucket is for land improvements like driveways, parking lots, landscaping, things like that. So basically we're saying they're going to deplete over a much faster time period than 27.5 years. So that's what a cost segregation study does. It allows you to allocate value to shorter life components, and then depreciate faster as a result. Because if I'm depreciating $27,000 over 27.5 years, I'm getting $1,000 a year in depreciation. But if I take that $27,000 and I'm depreciating it over 5 years, now I'm getting like $5,500 of depreciation every single year for at least the first 5 years. So I've increased my annual depreciation by $4,500 by doing that reallocation for at least the first 5 years. And that's real money, especially when you're a real estate professional. And I'm accelerating my paper losses because depreciation is just there to track the deterioration of my asset. It's a thank you from the IRS for investing in our infrastructure, investing in real estate and providing housing to people. That's what it's just an investment. Thank you for your investment. You get to take this paper deduction every single year. You don't have to spend more money to take it. So I get a $4,500 deduction every single year, and that's it. I don't have to spend more money. I already bought the asset up front. So that's what depreciation is. Now, with cost segregation studies, we can now 100% bonus depreciate any component with a useful life of less than 20 years. So that 5-year, 7-year, and 15-year property can now all be 100% expensed in the year that I acquire an asset. So I go and I buy a duplex for $200,000. I do a cost segregation study, and you'll just have to trust me on these numbers. I can probably allocate $50,000 of the $200,000 purchase price. I can allocate about $50,000 to property with a 5, 7, and 15-year life if I run a cost segregation study, which means that I can immediately expense $50,000. So I buy a property for $200K. I probably put $45,000 into the property, and I immediately get a $50,000 tax loss. And if I'm a real estate professional, then I can immediately claim that tax loss against my taxes. So that's how those two strategies kind of blend together. So it's important to qualify as a real estate professional, but then it's really important to maximize your opportunities while you are a real estate professional. Oh, my list just disappeared. There we go. All right, before we move on, I want to hit. So somebody asked me privately, if my wife is a real estate agent and husband is an engineer, we file jointly. Okay, so if you're a joint filer, only one spouse has to be a real estate professional, but they have to hit real estate professional status completely on their own. Okay, so if you have a real estate agent as a spouse and they become a real estate professional, then you jointly are a real estate professional as long as you file a joint tax return. If you file a separate tax return, then each one of you has to be a real estate professional separately. So for real estate professional status and meeting that 750-hour test more than half your time, you or your spouse has to hit that by yourself. But for the purposes of material participation, you combine the spousal time. So even though I run a CPA from full time, if my wife went out and became a real estate agent, and that's all she did, let's just assume she has zero interest in the rentals. So she goes out and becomes a real estate agent. She's a real estate professional because she's a real estate agent full time. That's all she does. So she hits the 750-hour test, hits the more than half her time test by herself. She's a real estate professional. Doesn't matter. Our rentals are still passive. But let's say that I'm self-managing our rentals in all of my spare time. Let's say that I'm self-managing my rentals. So I'm gonna meet the substantially all participation test. She gets to count my time. For material participation, she can count my time. So once you hit that first threshold, the next threshold of material participation, you can combine spousal time. So I hope that helps the understanding there. All right, let's move on. I'll come back around to some of these other questions people are asking on real estate professional here in a little bit. All right, so some other opportunities for those of you that can't qualify as a real estate professional, because generally that's what happens is somebody will go, okay, this all sounds great. And there's a ton of bad information out there on real estate professional status. So you really got to watch out. We have a 12,000 word guide on it. If you want to see all the ins and outs, the technical citations and everything, and know that you're doing it right, you can check that out. And we can link up or something later with that. But there's a bunch of things that you just have to be aware of. Like you have to know what hours count towards the 750 hours. Like you can't just go and count education hours and research hours. So there's a lot of ins and outs. If you want to qualify as a real estate professional, I highly recommend that you educate yourself on it and get up to speed on what does count and what does not count, so that you don't get into an audit situation that you can't lose or that you can't win. But if you can't qualify as a real estate professional, because that's typically where we go next, then there's still opportunities for you. So I can go buy a rental property and create passive losses, right? So same sort of situation. I buy the $200,000 duplex. I cost segregate it. I get a $50,000 tax write-off the first year. It's going to create a tax loss. Well, that tax loss is passive. And remember our two buckets. If it's passive, it's stuck in the passive bucket, unless I can recharacterize it as non-passive by qualifying as a real estate professional. So right now, let's just assume I can't. It's stuck in the passive bucket in this example. So how do I offset the loss? Well, I've got to generate passive income. Maybe I take $100,000 and I go and invest in a business that needs capital. Maybe they need the capital for expansion. And it's a random business. It does not have to be real estate. It can be anything. People have done this with surgical centers. They've done this with. They've done this with hair salons, dry cleaners, laundromats, I even think. So there's a lot of different things that you can do to create passive income. But basically what you're doing is you're investing in a business, and that business is going to produce income. And if you're not making management decisions, if you don't have voting rights, meaning that you're just purely like a venture capital partner in this deal, then that's all passive income that can be offset by the rental losses. So if you think about this strategically, even though you can't qualify as a real estate professional, you can still build out a rental portfolio that offsets income from this other business portfolio, this private business portfolio that you're building out at the same time. Or maybe you were running a business and you moved out of it at some point and you became passive. Well, it's just a matter of kind of restructuring some of your contractual obligations, and it could actually be considered income that you don't materially participate in. So it truly is passive. We've had that happen with a few folks that we know. So it's passive income that the rental losses get to offset. But even if that doesn't matter, so you can't qualify as a real estate professional, cost segs, that's out the door. You don't want to go buy businesses. Then what you want to start doing is making sure that every single year your repairs and your improvements on your rental portfolio are optimized every single year. And the way that we make sure that we have optimized repairs and improvements is we look at the 2013 tangible property regulations. Those regulations tell us how to treat expenditures. I spent $5,000 on this HVAC. Should I capitalize it as an improvement and depreciate it over 27 and a half years, or should I write it off today in full? And so right there, you can kind of understand why it's important to make sure that you're treating your expenditures correctly. Because on the one hand, I can write it off today in full. So that full $5,000, I get to take today. It's a tax deduction today. Or on the other hand, I have to depreciate it over 3 decades, almost 3 decades, a very long time to recover my costs. If we look at the time value of money theory, we want to take everything now, right this second, so that I can take that tax refund or those savings and go and reinvest them and grow the savings, right? So we want to take everything today. We don't really want to spread it out over 27 and a half years. So that's one reason that knowing roughly how the 2013 tangible property regulations work is going to be important. But the second reason, whenever I sell a property, if it was a rental property, I have depreciation recapture. And that is a tax on all the depreciation that I've taken or could have taken. So if I bought that property for $100,000, I allocated $10,000 to land, $90,000 was building. I depreciate the $90,000 over 27 and a half years. I don't do a cost segregation study, so I'm not going to worry about that. So I just depreciate this $90,000 over 27 and a half years. 3 years later, I sell the property and I've depreciated it by $10,000. I sell the property for $120,000. Most people look at that and say, I sold the property for 120. I bought the property for 100. My gain is 20,000. Accountants look at it and say, I sold the property for 120. I bought the property for 100,000, but I also depreciated it by 10,000. So my total gain is $30,000. And $10,000 of that gain is depreciation recapture. $20,000 of that gain is just depreciation, Section 1231 gain, just like stock appreciation, long-term capital gains. That $10,000 is taxed at a maximum 25% rate. So going back to my 2013 tangible property regulations, repairs versus improvements. If I can write this HVAC unit off today, that $5,000, if I could write it off today, I want to do that, not only for the time value of money purposes, but also because if I write it off today as a repair, I'm not depreciating it. If I instead have to capitalize it and depreciate it over 27 and a half years, not only do I recover my cost over 27 and a half years, which is not good, but I also, when I sell the property, I have to pay a tax on the depreciation on that $5,000 that I've taken up until the point that I sell the property, a 25% tax. So we want to write things off today because it's a double whammy. I get the savings today. I also save later when I sell the property because I don't have to pay anything back because I wrote it off today as a repair. I didn't depreciate it. So there's a couple ways to get this done. The first is called the de minimis safe harbor. That is a $2,500 safe harbor. Anything under $2,500, any item on the invoice under $2,500 can be immediately expensed. Your property does have to be in service. So that means that you have to have it rented or advertised for rent with the intention on renting it. Certificate of occupancy in place. You cannot buy a property and gut rehab it, advertise it as of the day of buying it, and think that you're going to be able to write everything off under the de minimis safe harbor. So you do have to, in order to use the de minimis safe harbor, you have to have the property rented or advertised for rent and service. But $2,500, anything under $2,500 can be immediately written off. So that's a lot of repairs, a lot of improvements that can be written off under with the $2,500 threshold. It is a book conformity rule, meaning that you have to have good bookkeeping in order to get this done. You can't just have no bookkeeping and expect your tax return to be tax optimized. It's not a tax, believe it or not, it's not a tax optimization rule. It's a book conformity rule. So I've got to have good books. And essentially what the safe harbor does is it just allows me to more easily write things off on my books or more easily account for things on my books by writing them off. So instead of having to try to figure out, should I capitalize this $2,400 expense or not, I can just write it off under the de minimis safe harbor and that's it, game over. But it is a book conformity rule. It starts there with good bookkeeping. So anything under $2,500 can be written off. Here's a cool thing with the de minimis safe harbor. The way the rules are written are that you can put materials on one invoice and labor on another invoice. So if I've got a $4,000 HVAC replacement, I can put the $2,400 HVAC on one invoice, the $1,600 of labor on another invoice. They're both below $2,500. I can write them both off under the de minimis safe harbor. Technically, with a narrow interpretation of the law, that is exactly how it works. Will it play out in tax court? We don't really know, but that's exactly how it works with the narrow interpretation of the law. So de minimis safe harbor is a big one. Kind of along those lines, the next big one is knowing the betterment adaptation restoration tests. So if I can't use the de minimis safe harbor, there's a couple other safe harbors I might be able to utilize, but assuming I can't utilize any of those, then I've got this $5,000 HVAC unit. So can't use de minimis safe harbor because it's over $5,000. What do? Do I have to capitalize and depreciate it, or can I write it off immediately? Well, the next step is to go to the betterment adaptation restoration tests. And we can dive into those tests for like literally hours. So without doing that, at a high level, if you don't make a material improvement to the system that's being improved, then you do not have to capitalize the improvement. So my $5,000 HVAC unit, if I put a $5,000 HVAC unit into a single family property, so I replace the current HVAC unit, put a $5,000 unit in, that is a restoration, or it's going to be a betterment. It's going to be one of those things because there is only one HVAC unit and we're looking at the HVAC system when we're looking at materiality here. So the HVAC unit affects the HVAC system, and there's only one HVAC unit on a single family home. Assume single story, just for grins. So one HVAC unit. So if I replace the one HVAC unit, arguably I replaced, 90% of the entire system. The remaining 10% is for the duct work and some of the electrical and that type of stuff. But let's think about a 10-unit apartment complex, apartment building. All 10 units are under one roof, and all 10 units have their own HVAC system. Let's say that I replace two $5,000 HVACs. So I've got a $10,000 total HVAC replacement. Most CPAs will capitalize that $10,000 HVAC unit, or that $10,000 HVAC repair. They'll capitalize it and they'll depreciate it over 27 and a half years. Why? Because $10,000 is a lot of money. So they'll capitalize, depreciate it 27 and a half years. But if you look at the betterment adaptation restoration tests, you actually realize replacing two out of 10 HVAC units is not a material improvement to the HVAC system as a whole. So even though I can't use the de minimis safe harbor, I can immediately expense the $10,000 it cost me to replace two out of the 10 HVAC units because it's not a material improvement to the HVAC system as a whole. And I do want to do that because, again, I recover my $10,000 cost today. So I get tax refunds or tax savings today. And I don't have to pay depreciation recapture tax whenever we sell the property at some later point. Very few CPAs get that right. Very few CPAs get that right. And that is an example right out of the Internal Revenue Code or right out of the Treasury regs. So, so I know that one's a legit one. So that's so important for everybody to remember. If you're a landlord, you have to get you have to get a good understanding of the de minimis safe harbor and the betterment adaptation restoration test. It applies to any sort of rehab. And when you start thinking about it, you realize, so I really, to optimize for taxes, I need to buy multifamily property. The more units under one roof, the better. Because think about the applications of this. I have a 10-unit apartment complex. All 10 units are under one roof. Well, December, I've identified at acquisition that I need to replace 4 units, pretty much gut rehab top to bottom. Well, maybe in December here, I replace 2 of the 10. All my costs theoretically are not material improvements to the systems that they are impacting. So my two unit turnover there is potentially optimized. And then in January, I hit the other 2. Right. So the year end stuff, it's great to do the rehabs because you can really make sure that you optimize your numbers. So I've said, okay, of the 10 units, I know that I need to rehab 4. I'll do 2 here in December, and then I'll do the next 2 in January. I've split the tax years. So assuming that I don't have to do any more in 2021, then I've theoretically fallen under that betterment adaptation restoration threshold for all 4 units, simply because I split the tax year up. Really important stuff. So the last thing with the betterment, the last thing with the 2013 tangible property regulations is partial asset dispositions. Now, this is one that everybody here should really understand. If you own any rental property, I would almost be willing to bet, almost. Sometimes people prove me wrong, but I'd almost be willing to bet that you've been doing this incorrectly. Most landlords have been doing this incorrectly. All right, so I buy a property, $100,000. $10,000 is allocated to the land. $90,000 is allocated to the building. But we've already talked about a cost segregation study, right? And what that does. That's the whole practice of saying, well, it's not just $90,000 building. There's things that make up the building. So we've got to value those things. Let's take the roof as an example. Maybe if you did a cost seg study, the roof would have a value of $8,000. Now, whether or not you do the cost seg study, your roof still has that value allocated of $8,000, technically speaking. Even if you just say $90,000 building, your roof is still part of that and it should be allocated value. And that's important to understand because when you replace the roof, you should write the cost of the roof that no longer exists off. It should be written off of your return because it no longer exists. Otherwise, you're depreciating 2 roofs. I'm depreciating the roof that I bought when I bought the property because technically it had value. Technically it had value. And then 2 years later, I replaced the roof with a new roof. Now I'm depreciating the new roof. And if I don't write the old roof off, I'm also depreciating the old roof that no longer exists. We've seen instances where people have 4 roofs on one property that they're depreciating just over time. Just never wrote the old roofs off. But that's what a partial asset disposition does. It allows you to write off the cost of the component that no longer exists. You can do this with flooring, framing, cabinetry, countertops, tiling, roofs, windows, doors, landscaping, parking lots, driveways, you name it. Every component in a property has value. And if that property's been replaced, if that component's been replaced and it no longer exists, the value that it should have been allocated should be written off of your tax returns. That right there will save you more money over 2 decades than real estate professional status ever will. People always get so hyped up about real estate professional status. And I go, yeah, but have you heard about partial asset dispositions? They go, nah. And they keep moving. I'm like, oh my gosh, you just lost $100,000. I mean, partial asset dispositions are an incredible way to save tax dollars. Incredible way. If you know that, if you know how to work partial asset dispositions, and you don't have to know it, you just have to know to bring it up with your CPA. Hey, I replaced 5 windows. Can we write the cost of the other 5 windows off this year? Yeah, absolutely. If we're capitalizing the new windows, absolutely. So those rules will save you more money than real estate professional status ever will. I promise you. I promise you. All right. I'm going to hit short-term rentals, and then I'm going to throw a bone to our folks that are not landlord focused. So short-term rentals. So part of the real estate professional conversation is typically when people talk to us, they go, okay, after talking to you guys, I realize it's a lot harder to get real estate professional status than I thought I was going to get. I'm probably not going to qualify. My spouse isn't going to qualify. So what's next? When we talked about what's next, there's a couple of options. One, you invest in businesses, and those businesses offset your passive losses. Two, you get really good at the tangible property regulations and understanding how those work, understanding partial asset dispositions, because you can always optimize your rentals, even if you're not a real estate professional. But let's just say that you're like, you know what, Brandon, all this is great, but I'm only going to work with you if you can tell me how to save $30,000 right this second, and real estate professional status is clearly out the window. And my answer to that is buy short-term rentals, buy Airbnb properties, VRBO properties. If you rent a property on average, if the average rental period is 7 days or less per tenant, then you do not have a rental property per section 469 of the code. Now, section 469 is everything that we just talked about. It's, well, not everything, but most of the stuff. It's real estate professional status. It's the whole passive losses, passive income. That's all section 469. So if I have a rental property where my average rental period is 7 days or less per tenant, then I do not have a rental property under section 469 of the code, which means I do not have to be a real estate professional in order to take the losses from my short-term rental property. All I have to do is materially participate in the property's activities or the property's operations. And remember, there's 7 tests for material participation. The easiest test is that I complete substantially all the participation. So what does that tell you? I buy a short-term rental. I list it on Airbnb and VRBO. I get a handful of tenants in. They're all, one of them stays for 20 days, but then all the others stay for 2 days each. So across all of my tenants, I have a less than 7-day average. And because of that, I don't have a rental property, and I'm self-managing the property. So I complete substantially all the participation. That's the easiest material participation test to hit, the lowest threshold. I spend 25 hours between now and the end of the year doing it. And I materially participate in my short-term rental activity. It's now a non-passive activity. So I've recharacterized it from passive to non-passive. I run a cost segregation study on single family homes like cabins, vacation homes. You typically get about a 15 to 20% allocation from your purchase price to 5, 7, and 15-year property, which means that I can immediately write off about 15 to 20% of my purchase price. So I buy a $200,000 cabin, and I immediately write off $40,000 thanks to 100% bonus depreciation. It creates a tax loss of $100,000. And because I have rented it 7 days or less per tenant, because I complete substantially all the participation, because I'm self-managing, then I have a non-passive loss, non-passive $40,000 loss, which allows me to write that off against my W-2 income, even though I'm working full-time, even though my spouse is working full-time, everybody's working full-time. I could still buy short-term rentals, write the loss off against my W-2 income, against my business income. It's a really, really cool way to kind of accelerate your rental portfolio acquisition strategy if you want to use the tax losses to fund it. Now, there's rules with short-term rentals. You got to be really careful. You don't want to use the short-term rentals personally very much. Definitely not more than 14 days. So be careful with that. Otherwise, you're subject to your short-term rental to all sorts of different rules. The next year, you can get a property manager on it. The next year, that's fine. It's calendar year to calendar year. This calendar year, I self-manage, so I complete substantially all the participation. Next calendar year, I get a property manager, and I'm fine with that. It's a totally fine approach. This year, I'll be a non-passive. This year, the activity will be non-passive. Next year, it'll be passive because I'm not going to be materially participating because I have a property manager. If your short-term rentals are far away, you've got to, again, be really careful. because you can't be managing the property manager. It's not going to count. You got to be involved in the day-to-day operation. So if my short-term rental's 300 miles away and I rarely go visit it, I'm going to have a really good use case for the fact that I self-managed it, meaning that the property is going to have to be a smart property where people can check in, check out. I might be able to place some cleaning crews, but ideally, I'm also going out there and cleaning the property myself because I'm completing substantially all the participation. Otherwise, I got to look to that next material participation test, which is 100 hours and more than any one other individual, which I could do if I wanted to have cleaning crews do the unit turns every single time. So you've got to actually go down there and really swing the hammer type of thing, really move your property forward, manage the day-to-day operations, the rentals. But that's a great strategy for people that want to invest in real estate and also want to yield current tax benefits. It doesn't yield the best tax benefits. And in future years, Airbnb properties, if they're in good locations, they cash flow like crazy. But think all the way back to the beginning of this conversation where we talked about what happens if you can't be a real estate professional. You buy rentals anyway. They create large passive losses. Well, guess what? My Airbnb property, next year, I put a property manager on it. And it's going to generate large amounts of passive income because short-term rental, it's a nice area. It's always rented out. Rents for a higher rate. So large amounts of passive income. Well, I can go buy regular rentals and I can create passive losses for my regular rentals because my short-term rental is now passive. The property manager is managing it. So now it's going to give me passive income that I can use to offset my passive losses from my other rental real estate activity. So really nice way to kind of merge everything together. All right. Now, for the non-landlords out there, if you're running like a real estate trader business, if you're running a service business, any type of business, entity structuring is really going to help you out if you do it correctly from a tax perspective. A lot of our landlords come to us and they go, well, I want to structure my entities to save on taxes. That's just never going to happen. You don't structure entities to save on taxes if you're a landlord, but you do structure entities to save on taxes if you're running a business. So real estate agent business, service business, basically receiving 1099 income. Ideally, you can receive the 1099 income in an LLC's name. And then what we do is we tax the LLC as an S corporation. Because if you earn $100,000 net income, you're going to pay a 15.3% self-employment tax on that net income. So $15,300 on the net income. If we pass that same net income through an S corporation, what we do is we run payroll and we pay you a reasonable wage. There's a whole calculation that goes into it. I would not recommend doing that yourself because you will get blown up in an audit. But what we do is we basically pull Bureau of Labor Statistics data. It's all public, so it's not like secret. But we basically model it out for you, and we say, here's what your reasonable wage should be. And as long as you have something defendable, then we're fine. We can report that all day long. So on our $100,000 net profit, a reasonable wage might be $50,000. Well, the S corporation, we would tax your LLC as an S corporation. The S corporation would pay you $50,000 W-2 wages throughout the year. The remaining $50,000 you would just take out as a cash distribution or dividend. But the cool thing is that 15.3% tax is only levied on the W-2 income, the $50,000 of W-2 income. So in this example, we went from paying that 15.3% tax on our entire 100K to only having to pay it on a reasonable wage, the W-2 income of $50,000. So we saved $7,650. You have to be careful with this. It is very state by state. So if you live in Tennessee or New Jersey, or New York City, you've got to run some special analytics to make sure that it's going to work. California gets a little wonky with flippers that are running S corporations, but most other businesses are okay in California. So you just got to be careful depending on the state that you're located in with what you're doing there. And I think I'm going to pause there and get some questions if that's okay.
Yeah, I think we got several questions. So Doug wants to know, if your losses are passive, does it make a difference?
Doug, can you
Doug,
elaborate?
can you unmute yourself and ask again, Doug? All right, well, while we're waiting for Doug. Brandon, on, let me see, there was one more. Okay, so for Michael, um, what is the best way to depreciate a 60K rehab if if I plan to hold the property long term?
Yeah. So with a $60,000 rehab, most likely you're going to be subject to the startup cost rules, which is found in section 195. Yeah, 195 of the Internal Revenue Code. Most likely you're going to have to capitalize that rehab and then depreciate it. And what I would be doing if I were you is a best practice for everybody here is to just itemize your rehab as much as you possibly can. So don't give me a $60,000 scope of work request or something from a general contractor. I want to see it broken down. I want to see $10,000 went to the plumber. Then I want to know what the plumber spent it on, what materials, what part was labor. It's a real pain in the butt to get your contractors to do all of that, but it will also help you. It could help you. I'm not gonna say it will help you. It could help you later on. So it's a good best practice to get into, no matter what. Even if you have to capitalize the entire $60,000 and depreciate it, we still might be able to bonus depreciate some of it, depending on if we can make different cost allocations.
Got it. All right, folks, if you want to unmute yourself, we got about 11 minutes left, and then we'll still have time. If you have time, we'll do networking. But for Doug, we got I mean for Brandon, we got about 11 minutes, and I don't want to. Yeah, I know you're super busy, Brand.
Yeah, no problem.
All right, beautiful. So if you got questions, just unmute yourself. Lon, Lakshman, Brian, anybody. Dave. Uh, the
And I've got a couple here that people have chatted me
Okay, yeah,
privately. So
yeah, yeah.
let me jump on those. So the first one is if there are two partners, 50% ownership each, and there's 100K depreciation, can it be allocated 75-25, or does it have to be proportional to the equity share? So you can make special allocations of depreciation as long as they have what they call substantial economic effect. I'm not going to go into what that means, but ask your CPA and probably a tax attorney to see if your special allocation of depreciation has substantial economic effect. It's called SEE. They should know what that means. If they don't know what that means, then find another CPA that does know what it means to help guide you through it. Otherwise, your special allocation could get blown up. And a special allocation is any allocation that does not adhere to the proportional share of ownership. So if we own it 50-50, and I give Bobby 75% of the depreciation, that's a special allocation. It needs to have substantial economic effect. Keith, I see that you asked, do you need to be a real estate professional to utilize cost seg? The answer is no. So anybody can cost seg the property. And what's going to happen is there's going to be a big tax loss created as a result of that. The question is the tax loss passive in my passive bucket, or is it in my non-passive bucket? And it's always default in my passive bucket. Unless I qualify as a real estate professional, then it's in my non-passive bucket, assuming I also materially participate in the activity. Can stock market passive losses be used to offset loss from cost segregation? Great question. Any stock, bonds, dividends, futures, options, interest, that is all considered non-passive. So that's in my non-passive bucket. So I can't go and create rental losses to offset my gain from my Apple stock sale, because those are two separate buckets. I could recharacterize my rental losses as non-passive by qualifying as a real estate professional, and then it could offset all that type of stuff. But yeah, those are two separate buckets. Great question. Somebody asked, what does it cost to do cost segregation? And it really depends on the smaller properties. You can use KBKG. They have an online cost segregator tool. That's what they call it, cost segregator, KBKG. You can also use ELB, Elephant Leo Bob, ELB. They also have a software tool. It's called DIY Cost Seg, I think, DIYcostseg.com. Both of those companies are really good. They've been around for a while. They have tons of data. And essentially what they've done is they've created software programs to allow you to do a cost segregation study by yourself on the cheap. They cost about $500 a pop for each cost seg. Very cheaply done. Now, caveats, of course, they have not been tax court tested. So there is audit risk. So the next thing that I would tell you to do is also make sure that you buy their audit insurance so that they do come out and represent you should things turn sour at some later point. So just be careful there. But they are using modeling data, and I've gone through it. It makes sense. I'm totally comfortable reporting it on our clients' tax returns. But again, there is some risk because it has not been tax court tested. The bigger cost segregation studies, like the ones where they actually fly an engineer out to walk the property and count all the windows and all the square footage of the carpet, that's going to cost you anywhere between probably 3,500 to 12,500 on larger properties. So it'll cost a lot more money.
But that's more appropriate for multifamily or commercial properties.
Yes. Yep. Mobile home parks are great for cost seg too. So yeah.
Yeah. And Brandon, one question: what are real estate investors doing, both active and passive? Flippers, wholesalers, buy and hold people, that is getting them often into trouble with the IRS. Like, what are some of the challenges that you're seeing across you, because you have such a large client base? Where are they getting in trouble or getting audited? What are some of those areas?
Investors or wholesalers, flippers, agents?
Um, let's cover both active, like
Okay.
real estate agents, flippers, wholesalers, and then you got another set of folks, that are just passive investors because they got a day job, but they got a bunch of real estate as
Yeah.
rentals.
Yeah. So let's take the passive investors first. Let's say that you've got a W-2 job or you're running a business and you're investing in real estate on the side. Where people get nailed is not understanding how the real estate professional rules actually work. So everything that I just told you is very high level. It gets very granular, very technical, and you really need without trying to be promotional, you really need a really good CPA to guide you through the ins and outs of that. It's the second most litigated piece of the entire tax code. So you really should not be going and claiming real estate professional status without going through some level of scrutiny by some CPA team that really knows the code inside and out. That's the number one place that we see people get nailed. And what happens is, people come to us and they'll say, well, I want to be a real estate professional. And we'll look at it and we'll say, well, it's going to be really difficult for you to do. Like what sort of hours are you logging? And they'll say, well, I'm logging the seminars that I'm going to and all my travel hours and all the education hours. And I spend a lot of time looking on the MLS for properties. And so all that time should count. And we'll say, look, that time does not count. It's not going to, the IRS is going to strike it down. The tax court's going to uphold the IRS's position. They're not going to side with you. And people get really mad at us when we say that. And what I always try to reiterate to people is this is a piece of the code where you should not go through the CPA cycle, go interview 5 firms and work with the firm that tells you what you want to hear. People want to hear education and research and travel time counts. Why? Because it's super easy to log. I could sit here on this Zoom meeting and say that I logged an hour, right? All of you guys could do it. I could travel to my property 300 miles away and bam, just logged 6 hours door to door. I could spend 4 hours a day on the MLS, never buy a property and say that but none of that time counts. So I want to hear that time counts, but none of that time actually counts. And firms that tell you that they do pose great risk to you, because here's how the audits work on this type of stuff. There's 2 ways to get audited. One, you go through the computerized program and your return just happens to get pulled because they're looking at your returns data and they're comparing it to the tens of millions of other returns that they have that are similar to yours. So that's one way to get audited. The second way to get audited is through some related party audit. So somebody gets audited, and because of that, you get audited too. And so here's what happens with the CPA firms. And I know this from personal experience because this is what happened to about 15 of our clients that came into us at the beginning of 2019. Their CPA had claimed real estate professional status for all of them, all of their clients. One client got audited, they lost. Then 3 more clients got audited, they lost. Then what happened is they audited all the clients of the CPA. So you also have to recognize that, yeah, I could work with the CPA that tells me what I want to hear, but that poses a large risk for me that I'm going to get audited at some future point. A much higher risk than a firm that knows it inside and out and can defend the position. So I would say that's probably the biggest thing that I see today, aside from the partial asset dispositions, because that everybody misses that partial asset. They're all depreciating 5 roofs. But the biggest risk in terms of litigation is the real estate professional status, and hearing just not like just not kind of pushing back a little bit and saying, can you give me the citations on what you're talking about? Because it sounds too easy. It sounds too good to be true. And it probably is. On the agent side, the wholesaler side, it's typically going to be the S corporation status. They audit S corporations for reasonable comp. So I can't go in, like in a perfect world, if I don't have the S corporation, let's go back to that $100,000 example. I've got a $15,300 tax on my $100,000. That's FICA tax, Social Security and Medicare. I run the S corporation to reduce my exposure to that 15.3% tax. And I do that by running payroll for myself, paying myself a reasonable wage. Well, some people move the 100K into the S corporation and pay themselves $0, no reasonable wage, no W-2 at all. So the full 100K that used to be self-employment income, now because it's passed through an S corporation, the full $100,000 is a cash dividend, and it's not subject to the 15.3% tax, which means that in this example, you saved $15,300. But those people get audited and they lose every single time. You've got to pay yourself some reasonable wage, and you've got to have support for it. I can't tell you how many times we've seen people go to tax court and lose because they said, my CPA told me that it's about 40% of my net profit. Well, how'd you come up with 40%? The IRS is going to say, well, why not 95%? Because we want more of that 15.3% tax, right? So they're going to want you to pay everything in W-2 wages so that they get more of the 15.3%. You want to pay $0 in W-2 wages that you save the full 15.3%. So there's got to be somewhere in the middle. You meet in the middle, and that's what that reasonable wage calculation is. That's probably the biggest risk audit-wise that we see, is just people electing S corporation and not paying themselves a reasonable wage, or they pay themselves $10,000 on $300,000 in earnings, and it's just not going to fly.
Makes a lot of sense.
Yeah.
Makes a lot of sense. All right. I got one last question. If I'm a real estate professional and I buy a large multi-tenant property, and I say cost segregate and take bonus depreciation and get a 800K loss, can I use that to offset income from converting an IRA to a Roth IRA?
Sure. As long as the loss is non-passive. Because again, all we're doing, I always try to simplify it. We've got 2 buckets of income. We've got passive income and we have non-passive income. If I do a rollover, if I roll my retirement account from a traditional account to a Roth account, it's going to create a tax event. It's going to create taxable income, but it's non-passive taxable income. So it's not in the passive bucket. So it's non-passive. So if I go and do this cost segregation study, I'm a real estate professional. I created non-passive loss. I recharacterize that passive loss and move it over to the non-passive bucket. Then it can offset anything in the non-passive bucket. So absolutely, yes.
Excellent. Brandon, did you want to touch a little bit on your course that you're presenting soon? And today is the kind of the deadline or the offer. I think today is the day, right?
We're going to run it through Friday.
Okay.
But yes, tomorrow is our first live Q&A. So if you don't want to miss the live, then jump in there.
Gotcha.
Yeah, no, we're running a tax course. So this is our first kind of big run at this type of thing. The reason that we're doing it is, we talk about 60 new potential new clients a week. So 60 people a week are filling out our Become a Client web form. And we're talking to 60 new investors every single week. And I've just noticed that a lot of people miss the same stuff. And so what I thought I could do is create a lower cost way for you to get great information without having to pay us thousands and thousands of dollars and without having to second guess your CPA. So the entire purpose of the course is to basically put you through a fundamental training on the core tax strategies available to real estate investors. It is a focus on investors, not so much agents and flippers, though we do talk about some of that. But it's a 5-week course. They're all pre-recorded videos. We drop the new pre-recorded videos each week, and there's a live Q&A with me once a week. You also get a course community where you can go and ask questions, and I'll be jumping in there and answering questions. But the entire idea is to empower you to have better conversations with your own CPA, whether it's us or not. We don't have to take over everything else. It literally pains me. My parents are landlords. I'm a landlord. My sisters are soon to be landlords. It pains me to see all the missed opportunities and mistakes that we see. It's just you work so hard for your wealth, you put it into these real estate assets, and then you blow it all up because your taxes are a complete mess, and you're not maximizing opportunities, or you're skipping out on an extra 2 to 3% of your IRR. So it's just an answer to that. We just said, look, we don't have to take on everybody as a client, but we can certainly work to get really good information out there so that you can feel empowered to go talk to your own CPA. And one of the things that you'll learn too is that we're all about citations. You at the end of this course, you'll feel really comfortable going to your CPA and saying, this all sounds great, but can you give me a citation? And you can come back to our community and ask, this is what my CPA told me. Here's the citation. Brandon and team, what do you think? And we'll come back and say it's wrong, or yeah, it's right, and that's the correct interpretation. So we're really trying to create this one-stop shop on the web for landlords to go to get legitimate information.
Yeah, I'm always shocked. Towards March all the way through May, I get a lot of emails. Hey, can you recommend a CPA? Because suddenly they realize they're behind the 8 ball on getting their taxes done. And I just went through. By the way, Brandon does manage the taxes for one of my companies, but very happy, very professional. But I think this course is really needed. Mika is asking, Mika, if you click on the link, it'll tell you. But I shared a link with everybody in the chat. So that's the link. It's a let me see. I'll chat it again. But
yeah, and it's $1,497. So it's not inexpensive, but it's not nearly as expensive as getting like one-on-one planning with our firm or other firms that do the type of planning that we do. And at the end of the course, you will be able to join a private group that we're creating for our clients starting December 1st. So Bobby, there you go. But all of our clients and everybody that goes to the course will have access to that private group. And through that group, you'll be able to ask our team questions. We'll be giving out private content. We'll do live Q&As on an ongoing basis, and you'll be able to schedule advisory calls with us and get tax returns done with us if that's something you want to do too. But that group's only accessible if you are either a client of ours or you go through this course. So that's an extra kind of little benefit there. Now we are giving a full money guarantee for the first 2 weeks, but if you use the link that Bobby just pasted there, we'll give you guys a money back guarantee through the end of December. So if you go through the entire course and you're like, I just don't like it, I didn't get any value out of it, just let us know. As long as you use that link, as long as you sign up through Bobby's link there. So.
Well, Brandon, I didn't know that. Thank you so much for doing that. I appreciate that.
Yeah.
So look, like I
risk
said in my email, it's not what you make, it's what you get to keep at the end of the day. So, and many people have mentioned IRS is your partner in your business. So you better know the rules of the game. It's good to make money. It's the real estate market's been good to a lot of people, but you got to figure out what's working and what do you need, and especially for future. Like if you're about to go buy a rental property, you may think twice because now you have more knowledge about the tax code. So I really recommend, and of course, Brandon, the real estate CPA. We love what Brandon has done for all real estate investors. He's the go-to guy for many very prominent real estate investors. So and I haven't had any complaints. So I can stand behind recommending Brandon. Sam has one more question. Sam, go ahead and ask away.
Thank you, Bobby. I tried to ask on the chat, but didn't allow me. So, hey, Brandon, just have one question. You talk about the cost segregation. Basically, we using the depreciation, right, of the itemized depreciation. But when you do that, after you sell the property, do you have to pay back those depreciations?
Oh yeah, absolutely. Yep.
So
when you cost segregate, what you're doing is you're accelerating the depreciation. When you sell, you still have that depreciation recapture. So you would have to pay it all back. So it's basically an arbitrage of time, the time value of money essentially. So I cost segregate today. I get a $30,000 tax refund. I reinvest that tax refund. I sell after 7 years, assuming I've pulled a 12% return on my $30,000 tax refund. I've doubled my money. So now I've got 60,000 and I pay 30,000 back whenever I sell. That's essentially what you're doing.
Yeah.
You're just arbitraging the time.
Yeah.
Oh, okay. So it's like a deferring it to a later date.
Yeah.
Right? Okay.
Yeah. And you can always 1031. You can 1031 and
Yep.
just kick the can down the road. All of the gain gets rolled over. You can invest in opportunity funds, kick the can down the road.
Even
So
further.
there's a couple things you can do. You can keep deferring.
All right.
But
Thank
all of that, Sam, all of that comes with knowledge and with knowing the tax code and being surrounded by people that are in the business, that are working similar systems, you know. So become an insider. So that's what I would say. Become educated. But if whether you're active or you're passive, unfortunately, we all got to learn some of the. But then you go to somebody like Brandon, and you give them the information in the right format, so that they're not spinning their wheels trying to figure out what you did. You've already been prepped. Your books are already prepped. They're organized, so that they're not having to bill you extra for all the work that they have to do. But it's 109. But I posted the link. I'll send out an email. But if for the folks that want to stick around, we can do some networking. But Brandon, thank you so much. We'll do this again, I'm sure.
Thanks, guys. I really appreciate you having me. Taxes are fun for me, maybe not as fun for you. But Bobby, I really appreciate it, man. Thanks so much for having me on.
You bet. Thank you, Brandon.
Bye, guys.
All right, folks, we can stick around, and if you got time, I'd like to demo something to you, but only if you have time. It just takes about 5-10 minutes. But again, unmute yourself, ask questions, introduce yourself. We can do all that. But while we're doing that, I wanted to share this website that I've been developing for real estate investors, and I'm going to show you how you can manage your assets. So a lot of what Brandon talked about was having all the proper documentation, all the proper information about your assets in one place. So I'm going to just show you how to add a property. So any address. So in this case, I'm going to pick a random address. It's this property here. It's near Kansas City, Missouri. And I'm going to show you that it's my rental. I'm the owner. This is my email address. It's not self-managed. Let's say I use Cozy to manage this property. Then what I do is I come in here and I say, what's my lease? It's a really simple website. What was my deposit? And what are my operating expenses? So let's say I say 900 is my taxes. It's yearly, and it's due on, let's say, December 10th. My insurance is 700, and it's yearly, and it's due, let's say, on February 1st. So that I'll get a reminder. For mortgage, it's going to be, what's my mortgage? So I'm going to say 81,000. My interest is 3.75. It's a 30-year fixed, and there's no escrow. So it's going to calculate my mortgage, and then my property management is $90 a month, and it's monthly. And then the last tab is, when did I buy it? So I'm going to say I bought it in 2015, let's say April 1st, April Fool's Day. My purchase price was 61,000. Down payment was 20,000, and I bought it inside one of my LLCs. And that's it, right? That's all I have to do. I click on update, and then I go to my transactions. And I know I'm going through this really fast, but you can import all your historical transactions. We provide you with an Excel template. But in this case, I already have a file that has all my historical transactions. It's called demo 13005. I'm going to bring that in and I'm going to click on save. And what it's going to do, it brought in all my transactions. I can also store my documents over here. So I'm going to say, let's say I had a PDF or pictures. So here's a PDF. Let me see if do I have any other PDFs. Let's say that, let's just go with that. I can click on upload, and then I can tag it. I can say this is my 2019 lease. So if I ever do a search on 2019 or lease, it'll find it, right? So now I go to overview, and this is the performance of my property. What's my net operating income? What's my cap rate? What's my total ROI? What's my equity? It's figured all this out. How did it do last year? Here's what it did last year in income and expenses. This year in income and expenses, this is what it did. And then I can also add pictures. So I'm going to go here, and I'm going to go to sample home pictures. This is my folder. I'm going to say, here's all my pictures. I'm going to upload, and in a couple of seconds, it's going to upload all those pictures. And here we go. I don't know what happened there, but here we go. Here's some pictures of the property, right? So I may have some wrong pictures in there, but you get the idea. So now I can go to my dashboard. I can track my rentals. I can track my private money lending. I can track my syndications, all the information. I can track my primary, all in one place. So this is called Better Capital. It's built for real estate investors. It's free to use, but the idea is that if you're a real estate investor, and along the lines of what Brandon was referring to, we will give you. So, for example, I'll just show you real quick. This won't take very long, but I'll go to my this property that I had just created. All these transactions, you can export these transactions. So at the end of the year, we give you something like a Schedule E, which is a report that you can provide to your CPA. So in working with Brandon and other CPAs, we created an export that you just, if you have all your transactions in one place, and by the way, we have bank integration, you can integrate with your property management. If you want, I can do a one-on-one demo with you. But you bring all that information in, and then at the end of the year, you just click one button and export that Excel file, and it'll go to you can send it to your CPA, you can check it, but it generates an Excel file. So we built this, took me and my partner about a year and a half to get this thing fixed and up and running, but it's free to use. Maybe down the road we'll have a subscription model, but right now it's completely free. Please, if you got, it's called bettercapital.us. So again, bettercapital.us. And if you got time, just give it a try. Here's the main website. So bettercapital.us. It's really easy. If you got Gmail or whatever account, you can just click here and it'll take you to your dashboard. You can start tracking and the properties, regardless of where the properties are. They could be out of state, they could be multifamily, they could be single family, private money loans, all that. You can manage it all in one place. So anyway, thank you for listening to me, and hopefully you like what we have developed. But give me your feedback. we want to hear, what you think of the website. If you come across any problems, let me know. But again, if you need something, just unmute yourself, introduce yourself, and let's keep. And we've got more events coming. Hopefully, you liked what Brandon had to share, but there's a lot more involved in with real estate. So just see if you can get a little bit better educated, and save yourself a bunch of money as well. So thank you, John. Thank you. Dan P, there's some overlap, but it's a lot different. But Dan P, if you shoot me an email, I'll give you some more history. Mika, thank you for listening, and hopefully you learned something new as well. But guys, if there's nothing else, we can wrap it up. But otherwise, feel free to ask questions. Thanks, Lon, and we'll connect soon. But have a wonderful day, and stay in touch.
Thank you, Bobby, for the great event. Thank you.
Thank you, Vinay. All right, take care.
That's awesome.
Okay, bye-bye.